Kenya started the second decade of the 21st century as a 2.3 trillion shillings economy, which was struggling to shrug off the effects of the post-election violence of 2008 and the global financial crisis. Now, 10 years later, the economy has more than tripled in size to 8.9 trillion shillings, with growth as high as 6.3%. Now, I should mention that this takes into consideration the rebasing of the economy in June 2014, which scaled up its size by as much as 25%. But how exactly will Kenyans remember this decade from an economic standpoint? Let's take a look at some of the thematic issues which are bound to shape ideas. The decade between 2009 and 2019 began with Uhuru Kenyatta as finance minister and ends with him as president on his second and last term. His first budget speech was tabled on the 11th of June 2009 and was a 790 billion shilling spending plan themed overcoming today's challenges for a better Kenya tomorrow. Over the last decade, the size of the budget has grown from the 790 billion shilling spending plan to the 3 trillion shillings tabled for the present financial year, as the country has sought to meet its growing appetite for expanding infrastructure, a surging public sector wage bill, and a rising demand for social safety nets. Over this period, the proportion of the budget taken up by recurrent expenditure, which is expenditure on goods and services which does not result in the acquisition of fixed assets, has moved from 76.5% in 2009 to a little over 80% presently. With this fast rising expenditure over the last 10 years, the government has been under immense pressure to pull up its socks as far as mobilization of tax revenue is concerned. Now, Kenyans will remember the last decade for a raft of tax policy measures which aimed at helping the government to bridge the deficit it encounters every year on year. Notably, Kenyans are bound to remember the reintroduction of VAT on petroleum products following the VAT Act of 2013, as well as the introduction of presumptive tax in January 2019 as the government looks to rope in the many small and medium-sized businesses into the tax base. At the start of this decade, the Kenya Revenue Authority raised 524 billion shillings in tax revenue, with 22% of this amount raked in from pay as you earn. 10 years later, the Kenya Revenue Authority is raising in the order of 1.6 trillion shillings in tax revenue, even as the headache of expanding the tax base to rope in the vast informal economy continues to be the elephant in the room. With tax revenue falling far below the country's expenditure outlay, Kenya's appetite for debt could only have risen over the last decade. This decade will be remembered as the one in which Kenya secured its first Eurobond in June 2014, raising $2.75 billion between June and December the same year. The country has since returned to the international capital markets to raise more foreign currency denominated debt. In 2009, Kenya's stock of public debt stood at 1.2 trillion shillings, which was split almost equally between domestic and foreign debt. This would, however, change in the succeeding years as the debt pile steadily rose to cross the 6 trillion shillings mark in 2019, with foreign debt accounting for 52% of the gross public debt. It will be worth remembering that it was in 2019 that both the Senate and the National Assembly gave a green light for an amendment to the country's public finance management framework, effectively revising the country's debt ceiling from the previous 50% of gross domestic product to a nominal figure of 9 trillion shillings. History will be the judge of the wisdom or the folly in this move by the legislators.
The 50% GDP debt ceiling is the same that is used for Burundi, same used for Rwanda, is the same used for Tanzania. We are not at the same economic power level with those countries. To speak of the budget that we passed here, as a country, this year, 2019-2020, was $264 billion. The budget for Tanzania, Uganda, Rwanda, Burundi combined is $260 billion. We have a huge economy. So you cannot compare and peg our debt ceiling at 50% like Burundi.
In principle, is not a bad idea. However, we have got to ask ourselves questions. What would happen if for example, inflation was to skyrocket in this country and therefore our GDP fell, given our current level of debt? If we were to reconvert to the ratio basis, you would obviously be over-leveraged.
On the monetary policy front, this decade saw the exit of Professor Njuguna Ndung'u from the Central Bank of Kenya and the entry of Dr. Patrick Njoroge in June 2015. Dr. Njoroge would receive a baptism of fire, with the Imperial Bank being placed under receivership in October the same year, after which Chase Bank would soon fall into similar headwinds in quick succession, being placed under receivership in April 2016. The challenges in the banking sector stability notwithstanding, this decade will be remembered as the one in which the Central Bank of Kenya reined in on high inflation, taming it below the target ceiling of 7.5% for the better part of the decade. The annual rate of inflation stood at its lowest point in 2018, when it averaged 4.8%, down from a high of 14% in 2011. On the currency front, this decade has seen the demonetization of the old series 1,000 shillings note, which took place between June and the end of September 2019. The exercise saw 7.4 billion shillings worth of old series notes rendered worthless as the central bank sought to tighten the noose on illicit cash in the economy. As far as the value of the shilling is concerned, the Kenya shilling is today exchanging to the US dollar at about 102 units compared to the 77.3 units in 2009. Effectively, the local currency has shed about 32% of its value over the last 10 years. The tail end of this decade has also seen intense debate as to whether the shilling is fairly valued or not, with the central bank rebuffing critique from players such as the International Monetary Fund that have claimed the shilling is overvalued. To their delight, Kenyans wrap up the decade with an economy which is growing relatively fast, inflation which has been kept broadly in check, and a currency which by regional standards has been markedly stable. Still, questions about a deteriorating debt position, pervasive unemployment, and failure by the growth dividends to trickle to the bottom of the pyramid are bound to shape public debate going into the next decade. Julian Amboko, NTV.